Let me ask you something, and be honest with yourself for a second. Have you ever downloaded a trading app, put in a few $100s, maybe 1,000, bought a stock because someone on YouTube or at work said it was about to explode, watched it go up a little, felt like a genius, and then a few weeks later it's down 30% and you're sitting there staring at your phone thinking, what did I just do? If that sounds familiar, that's exactly who this video is for. Because most beginners don't lose money in the stock market because they're dumb. They lose money because they don't understand how the game actually works. My name is Ian, and I spend way too much time thinking about how people build wealth, how they lose it, and why they repeat the same financial mistakes over and over again. If you're someone who wants to invest, wants to grow your money, but secretly feels like you're guessing half the time, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, here's the thing. Most beginners enter the stock market thinking it's about picking the right stock. They think success is about finding the next Tesla or the next Apple. But here's what most people don't realize. Investing success is far less about what you buy and far more about how you behave. And that's not just my opinion. According to Dalbar's annual quantitative analysis of investor behavior study, the average investor consistently underperforms the S&P 500 by several percentage points per year because of bad timing decisions, buying high and selling low. Not because the market failed them, because their behavior did. And this is where it gets really interesting. The S&P 500 has historically returned around 8 to 10% annually over long periods. So if you invest $10,000 at 9% for 30 years, you're looking at roughly $132,000. That's without adding another dollar. But the average investor, because of emotional decisions, often earns closer to 4 to 5%. That same $10,000 at 5% for 30 years, about $43,000. That's an $89,000 difference. Same market, same time period, completely different outcome. And the only difference is psychology. Now, you might be thinking, okay, Ian, but I just need to learn how to pick better stocks. No, that's exactly what traps beginners. Because the first reason most beginners lose money is overconfidence, especially after their first win. Let's say you buy a stock for $500 and it jumps to $650 in a month. You feel smart. You feel like you get it. So what do? You put in $5,000 next time, maybe $10,000, but you weren't skilled, you were lucky, the market went up. In bull markets, almost everything goes up. It's like flipping a coin in a windstorm and thinking you control the wind. And then when the market corrects, and it always does, suddenly that $10,000 position drops 25%. Now you're down $2,500. That hurts, and pain changes behavior. Which brings me to the second reason beginners lose money. They react emotionally to short-term volatility. The market drops 10%, headlines scream crash, social media panics, and beginners sell. But here's what most people don't realize. Volatility is normal. Since 1980, the market has experienced an average intra-year drop of about 14%, yet still finished positive most of those years. So the drop isn't the problem, the reaction is. Investing is the only place where people run out of the store when things go on sale. If your favorite shoes drop from $100 to $70, you're excited. But if a solid company drops 20%, you panic. That's psychology. Loss aversion, to be specific. Studies in behavioral economics show that losses feel about twice as painful as equivalent gains feel good. So a $1,000 loss hurts more than a $1,000 gain feels satisfying. That pain pushes beginners to stop the bleeding by selling at the worst possible time. And this is where it gets really interesting. The market's best days often happen right after its worst days. According to research from JP Morgan, if you miss just the 10 best days in the market over a 20-year period, your returns can be cut in half. And guess when people are most likely to miss those days? When they panic and move to cash. Now let's talk about something slightly uncomfortable. Beginners don't have a strategy, they have vibes. They say things like, I feel good about this company, or it's trending, or everyone's talking about it. That's not a strategy. A strategy answers three questions. What am I buying? Why am I buying it? And when will I sell it? Without those answers, you're not investing. You're gambling with a better marketing team. And look, I'm not saying that to insult you. I'm saying it because I've been there. I remember early on putting money into a stock because a coworker said it was undervalued. I didn't read earnings, didn't check debt, didn't even know how the company made money. I just bought it. It dropped 40%. I held it out of pride and eventually sold it for a loss because I was tired of seeing red. That wasn't analysis, that was ego. Which brings us to another massive reason beginners lose money. They tie their identity to their investments. When the stock goes up, they feel smart. When it goes down, they feel stupid. So instead of admitting they were wrong, they double down. It'll come back. Sometimes it does. Sometimes it doesn't. Meanwhile, their capital is stuck, and capital stuck in bad decisions can't grow elsewhere. Here's what most people don't realize. Successful investors aren't attached to being right. They're attached to making money over time. That's a psychological shift. It's not about winning every trade. It's about managing risk. And let's talk math for a second, because this part is critical. If you lose 50% on an investment, you don't need a 50% gain to break even. You need a 100% gain. If you invest $10,000 and it drops to $5,000, you need it to double just to get back to where you started. That's why risk management matters more than chasing upside. Beginners focus on how much they can make. Professionals focus on how much they can lose. Now you might be thinking, okay, so what should I actually do? Great question. First, understand what you're buying. If you can't explain in simple terms how a company makes money, you probably shouldn't own it. Second, diversify. And I know that sounds boring, but boring works. Index funds that track the S&P 500 have outperformed the majority of actively managed funds over long periods, not because they're flashy, but because they're consistent and low cost. Third, automate your investing. Dollar cost averaging, investing a fixed amount regularly regardless of market conditions, reduces the temptation to time the market. If you invest $500 every month, sometimes you buy high, sometimes you buy low, but over time you average out your cost. That removes emotion from the equation. Fourth, zoom out. The stock market is a tool for long-term wealth building, not a weekly scoreboard. Historically, the market trends upward over decades because businesses innovate, populations grow, and productivity increases. But in the short term, it's chaos. If you check your portfolio every hour, you'll feel like you're on a roller coaster. If you check it once a quarter, it feels more like an escalator. And here's the final thing most beginners don't realize. The market is designed to transfer money from the impatient to the patient. That's it. It's not rigged against you. It just rewards discipline. The people who win are not the ones with the highest IQ. They're the ones who can sit still when everyone else is freaking out. They're the ones who stick to a plan when headlines are screaming. They're the ones who understand that wealth is built slowly, quietly, almost boringly. So if you're a beginner and you've lost money, I don't want you to feel embarrassed. I want you to feel educated. Because the loss isn't the problem. Refusing to learn from it is. Shift your mindset from how much can I make this month to how do I build wealth over the next 20 years? Build a strategy, control your risk, automate your investments, and most importantly, master your psychology. Because at the end of the day, the stock market isn't a test of intelligence, it's a test of behavior. And the good news? Behavior can be trained. So start small, stay consistent, think long term, and stop trying to get rich quick, because that's exactly how most beginners end up broke. I'm Ian, don't be broke, see ya.